One of the most important questions that a borrower will ask during the home buying process is, how do I get the lowest interest rate? Now, while part of this will depend upon the conditions of the market at the time that you go to actually lock in your interest rate, there are a number of different factors that absolutely will affect your interest rate. And by knowing what they are ahead of time, you can be better prepared to make sure that you guarantee yourself the absolute best interest rate at that day that you go to lock. Now, I've mentioned this in previous videos, but just a quick recap. The interest rate locks to a property address, not to an individual. So unless it's been communicated to you prior, your interest rate cannot be locked and is not locked until you have a fully accepted purchase contract. With that said, let's switch back to what this video is actually about. I had just mentioned that there are a number of factors that will impact your interest rate. So let's take a deeper look at what these factors are and how they could impact your rate. As you can now see, there are a lot of factors that come into play when it comes to your interest rate. Now, we're going to look at these on a more detailed level, but I wanted to show you the macro level overview so you have an understanding of how many different factors are truly in play here. So let's start with credit score. Now, when you're looking at advertised rates online, they are going to use 740 or higher as the standard credit score. And the reason that they do this is because that is where there's no negative impact to your interest rate. So as you'll see, this was a screenshot, I'm not gonna say the name, a very large bank. And you'll see it says mortgage rates valid as of the date and time, and assumed borrower has excellent credit, including a credit score of 740 or higher. So this is the goal when you're looking at your current credit score, and if it's not 740 or higher, we need to find out how to get it there. Now keep in mind, there's actually going to be 3 credit scores that are used. Now as a lender, we use something called a FICO score. And what that means is we pull from 3 bureaus. We pull from TransUnion, we pull from Experian, and we pull from Equifax. And what they're going to do is that decision is going to be the middle credit score of those 3. So if you have 2 borrowers on a loan, it's going to be the middle score of the lower of the 2 borrowers. So keep that in mind. That's very important when it comes to your interest rate. So like I had mentioned, dropping below this 740 decision score is going to have a negative impact on your interest rate. Just how much, you ask? What we typically see, and again, everything in this video is going to be typically what we see because each investor is going to have slightly different modifications. So use this as a guide and as a tool. Okay, so when we drop below 740 but we stay above 720, it is not unlikely that you're going to see a 1/8 worse on your interest rate. So every 20 points that we drop on your credit score, you will lose an 1/8 on your interest rate. So your interest rate will get an 1/8 worse. Once we get below 680, that will start dropping by 1/4 points instead of 1/8. Next up is going to be the property type. Now, most rates that are posted are based upon a single family residence, and that's because there's no adjustment to your interest rate if you're purchasing a single family home. However, let's say that you purchase a condo. A condo will have a higher interest rate, so it would not be uncommon to see a 1/8 higher rate if you're purchasing a condominium versus a single family home. Now, something that you need to be careful of is every once in a while, you may come across a townhome that looks like a townhome, it smells like a townhome, and it shows like a townhome. But if it is illegally zoned as a condominium, you are going to have a negative impact on your interest rate when you go to lock that rate, assuming that's the property that you're purchasing. Next are going to be escrows. So real quick, what are escrows? Escrows are going to be your real estate taxes and your homeowner's insurance. And unless you're putting 20% or more down, you're going to be required to do this. However, if you decide to waive your escrows, if you're putting 20% or more down, you should understand that that is going to have a negative impact on your interest rate. So it wouldn't be uncommon for your rate to be 1/8 higher if you decide to waive your escrows. Next up is going to be your down payment. And the down payment gets a little tricky because sometimes more isn't always better. Unless we're 25% or more down, then it's always better. So what exactly do I mean by this? What I mean by this is that 20% down is actually often the worst rate. And the reason for this is because there's no buffer between the mortgage insurance, which would be required if you have less than 20% down, and there's no cushion beyond that 20%. So it's not uncommon to see a 1/8 worse interest rate if you're putting 20% down. Next up is going to be your loan amount. And now certain loan amounts are more desirable to an end investor. And as a result, a different rate actually may be offered for a different loan amount. And while this does change regularly, it doesn't always follow a set structure. So this is one on a case-by-case basis that you have to take, and your loan officer will educate you throughout this, but keep in mind that your loan amount certainly could impact your interest rate. Next up is going to be the purpose of the loan. So what do I mean by this? I simply mean, is it a purchase or is it a refinance? You're very likely going to see more advantageous pricing for your interest rate on a purchase versus a refinance. Now, if we take this one step further, the type of refinance is also going to play a role. So if you're simply doing a rate and term refi versus a cash out refi, you're probably going to have a better rate on the rate and term versus a cash out refi. So knowing what type of purchase you're making, whether it's a purchase, refi rate and term, or refi cash out, will impact your interest rate. Next up are going to be something called points. So what are points? Points are simply a fee that's paid in exchange for a lower interest rate. So the more points that you pay, the lower your interest rate will be. So if we look at an example, again, I pulled this from that same big bank that I cannot name by name, but I pulled this right from their website. You see they've got a posted rate for a 30-year fixed. And right to the right side, you see that there's something called points. It says 0.690. This is a percentage of the loan amount, which was $200,000 in this case. So what that means is that you could pay $1,380 in order to get that rate. So just know if you're going to pay points, you're going to get a lower interest rate than if you didn't pay points. Next up is going to be the lock period. So whenever an interest rate is locked, it has to have an amount of time attached to it. So the longer the lock period, the higher the interest rate can be. So if we look at an example, a 10-day lock versus a 55-day lock is very likely going to have an impact for the 55-day lock on your interest rate. By that same token, a 40-day lock versus a 55-day lock may not have any adjustment. Typically what you're going to see on consumer websites, if you're looking and looking at published rates, they typically will use a lock period of 25 to 30 days. So again, right off of a website, you can see here it says, we base the mortgage interest rate shown on a 30-day lock period. Under certain circumstances, a 30-day lock may not be available. So again, all things to keep in mind when it comes to your interest rate. Next up is going to be the mortgage term. So how long are you taking this mortgage out for? The shorter the term, the better the interest rate. So let's look at an example of this. Again, screenshot from that same bank, just to keep things consistent and illustrate this. So they've got a 30-year fixed loan and a 15-year fixed loan, and rates posted. You can see that the 30-year fixed is being offered at a rate of 6.5%, but a 15-year fixed is being offered at 5.75%. So the shorter the term, the better the interest rate. Next up will be your property use. And what I mean by that, is it going to be your primary residence? Are you buying a second home in warmer weather? Or are you buying an investment property? And depending what type of use you are going to use the property for, you're going to have an impact on interest rate. So you're going to have a higher interest rate on second homes and investment properties. Next is your debt to income. So debt to income is actually a ratio that's calculated that not only determines if you're eligible for that loan, so it determines your approval, but sometimes you'll actually see different impacts to your interest rate the higher your debt to income ratio is. So think the higher this ratio is, the more susceptible you are to an increase in interest rate. And this is something that varies by investor in a case-by-case basis. So there's not really a universal adjustment that we see here. It is just something that you should understand that could come into play on your loan. So now that you've seen what these factors are that can impact your interest rate, let's look at a few examples together. All right, so let's take what we just learned and put it into use. This is example loan scenario number 1. Let's say we have a borrower who has a 725 credit score that's purchasing a condominium, putting 20% down, and they are not waiving their escrows. Now let's assume that the par rate that day was 6.75%. And when we say par rate, what we are talking about is a rate that a borrower is not paying any points for, and it is a rate that does not have any lender credits built in. So it is essentially the best available rate for that person that doesn't cost them anything extra that day. So looking at this scenario, let's look at our probable rate adjustments. Again, we won't know specifically until we go through each investor, but we have a framework to work off of. So we know that with a credit score below 740, but above 720, it's likely that we're going to see 1/8 worse on their interest rate. We also know that they're purchasing a condominium, which we will very likely see another 1/8 added to their interest rate because it's a condominium versus a single family home. Next, they're putting 20% down, which we said 20% is usually the worst rate because there's no buffer from MI and there's no cushion that you would have if you're putting 25 or more down. So very likely to see an 1/8 added on to the interest rate. They are not waiving their escrows, so there's no negative impact here. So if the par rate that day was 6.75%, and we're likely going to see these adjustments, it would not be unlikely that this person interest rate that they would go to lock in this scenario would be somewhere around 7.125%. Let's look at another example. Now let's suppose that our borrower has a 716 credit score. They're purchasing a single family home, putting 25% down. They're going to waive their escrows, and we're going to assume the par rate is the same for all of these examples, so 6.75%. What would our likely probable rate adjustments be? On credit score, we're likely going to see a 4th added to their interest rate. And the reason for this is because we said each 20 points that you drop below 740 is likely 1/8 worse. So you can see here we've dropped 2 tiers, so not uncommon to see a 1/4 point added on interest rate. They're purchasing a single family home, so we're gonna have no impact there. They're putting 25% down, so there'll be no impact there. However, they are gonna waive their escrows, so very likely that we're gonna see an 1/8 added onto their interest rate. So in this scenario, they would not be surprised to see an interest rate of 7.125% if the par rate that day was 6.75%. Let's look at a final example. Now we've got a borrower with a 760 credit score, purchasing a single family home, putting 15% down. They are not going to waive escrows, and again, the par rate for that day, assuming 6.75%. So we're gonna have no impact negatively on their credit score because they're above 740. They're purchasing a single family home, so we have no negative impact here. They're putting 15% down, so there's no negative impact. Remember, I said down payment can be tricky. More is not always better. If 20% is our worst rate, what we know is that if we go above that to 25, we are gonna not see any negative impacts. And if we go below 20, we're gonna see no impact. And the reason you don't have a negative impact below 20% is because this borrower now has to pay monthly mortgage insurance. Next, they are not waiving their escrows, so there'll be no negative impact to the loan. So in this scenario, if the par rate was 6.75%, this borrower would very likely receive that same rate. Now again, keep in mind guys, these are just examples. Nothing is ever this simple, but this provides a really, really good framework as you're thinking about your own scenario so that you're prepared to put yourself in a position to get the best rate. So what are the key takeaways from this video? The first is that there are a number of factors that absolutely can and will impact your interest rate. And while some of these we can't control, such as if you're going to purchase a condominium, something that we can control, such as making sure our credit score is 740 or higher, is something that will put your best foot forward and guarantee that you are able to get the best available interest rate at the time you go to lock.